You already know you'll panic. You won't accept it yet. But somewhere beneath all that rational thinking, all those podcasts you've listened to, all those books you've read, all that advice you've absorbed, there's a part of you that knows. When the number on your screen falls fast enough and low enough, something will take over. And it won't be your calm, long-term thinking self. It will be the version that just needs it to stop. I'm not saying this to scare you. I'm saying it because in every market crash in history, 2001, 2008, 2020, and what quietly unfolded in 2025, the people who made real money weren't smarter than you. They weren't braver, they didn't have better information. They knew something about themselves that most people spend their entire financial lives avoiding. And in this video, I'm going to show you exactly what that is. My name is Maya. I'm not a financial advisor. Nothing in this video is financial advice. It's education. I spend most of my time thinking about why intelligent, INFO or MED people make terrible financial decisions at the exact moment it costs them the most. And what I've found over and over is that the answer is almost never about information. It's about something that happens before information even gets a chance to surface. Here's what we're covering today. First, what actually happens during a market crash. Not the numbers, but what goes on inside the people living through it. Second, the specific reason 90% of people end up on the wrong side every single time. Third, and this is the part most financial content never reaches, what the top 10% do differently, not in terms of strategy, in terms of structure. Stay with me because by the end of this video, you'll understand something about your own financial behavior that most people never figure out. And once you see it, you genuinely cannot unsee it. If you want to know more about my story and why I started this channel, I have a first video where I talk about all of that. Go check it out after this one. But right now, we have something important to get into. Let me tell you about something that happened in April 2025. The S&P 500 dropped 10% in a matter of days. Headlines everywhere: recession fears, trade war escalation. The kind of news cycle that, whether intentionally or not, is specifically designed to silence every rational thought in your head and replace it with one single overwhelming feeling: do something. Here's what's fascinating. For the first time in recent memory, retail investors, ordinary people, not hedge funds or institutions, actually bought into the dip. $5 billion net inflow in a single week. Regular people, many of them young, many of them new to investing, did the thing that every financial book ever written says to do. They bought when everyone else was scared. Now, before you feel good about that, I want you to sit with a different question. Where were you during that week? Not physically, emotionally. What were you feeling? What were you thinking about doing? Did you check your accounts more than usual? Did you feel the pull to move something? Shift something? Do anything just to feel like you had some control over what was happening? Because here's the truth the $5 billion story doesn't tell you. For every person who bought, there were many more who didn't, who watched, who waited, who told themselves they were being patient, when what they were actually doing was freezing. And freezing during a market crash is not neutral. It has a cost. A real, measurable, permanent cost that shows up years later in the gap between what your portfolio is and what it could have been. But we'll get to that. Drop a comment right now. Tell me honestly, during the April 2025 drop, or during any recent market volatility, what did you actually do? Did you buy, hold, sell, or just stop looking? I read every single comment, and the patterns in your answers shape exactly what this channel covers next. I want to tell you about two people. Same age, same income, same basic level of financial knowledge. Both had been investing for about 5 years when March 2020 hit, the fastest market crash in recorded history. The S&P 500 lost 34% in 33 days. The first person, I'll call him David, did what felt completely logical. He'd been reading about investing for years. He knew markets recover. He believed intellectually in long-term thinking. But when his portfolio dropped 20% in a week, something shifted. Not a decision exactly, more like a physical compulsion. He moved half his portfolio to cash, just to stop the feeling, just to make the numbers stop changing so fast. He told himself he'd buy back in when things stabilized. He didn't, because things stabilized faster than anyone expected. And by the time he felt safe enough to re-enter, He'd missed most of the recovery. The S&P 500 went on to gain over 100% from its March 2020 low. David participated in about 30% of that. The second person, I'll call her Sarah, did something that looked from the outside almost irrational. She didn't just hold. She set up an automatic contribution to buy more every 2 weeks, regardless of what the market was doing. She made that decision 6 months earlier, on a calm Sunday afternoon, when nothing alarming was happening. She wasn't brave in March 2020. She didn't have to be. The decision had already been made. The system was just running. Same crash, same information, completely different outcomes. Here's what I want you to notice, and this matters. David is not stupid. David is not weak. David is not undisciplined. David responded exactly the way any human being with a functioning nervous system responds. When they experience sudden, significant loss, he tried to make it stop. The difference between David and Sarah was not character. It was architecture. And that distinction is the entire lesson of this video. Now I need to tell you something that most financial content gets completely wrong about market crashes. Everyone focuses on the crash itself, the percentage drop, the panic, the headlines. And yes, that's when most people make their worst decisions. But the real damage, the damage that actually determines your financial outcome, doesn't happen during the crash. It happens in the 6 months before it. Here's what I mean. Right now, as you watch this video, insider selling is at one of the highest levels in a decade. The people running the companies in your portfolio, the CEOs, the CFOs, the board members, are quietly selling their own stock at a rate that should, if you're paying attention, tell you something about what they think is coming. This is public information. It's filed with the SEC. Anyone can see it. And yet most people don't look, or they look and don't act, or they act in the wrong direction. They see the market going up in the short term and have more because rising numbers feel good. And rising numbers feel like evidence that everything is fine. This is called recency bias. And it is a silent partner in almost every financial decision most people make. Your brain doesn't just have a problem with the present moment, which we covered in a previous video. It has a specific and deeply irrational relationship with recent history. Whatever happened in the last few months feels, to your nervous system, like a reliable guide to what's about to happen next, not because that's true, because that's how the brain was built. In 2007, the market was near all-time highs. Retail investor inflows were surging. People who had never invested before were opening brokerage accounts. The number kept going up, and going up and going up, and then it didn't. The people who got hurt most in 2008 weren't the ones who lacked information. They were the ones whose brains had spent 12 months being trained by a rising market to believe that a rising market was a natural state of things. Here's where it gets really interesting. The same mechanism that drove them to buy at the top, recency bias, the feeling that recent patterns predict future outcomes, also drove them to sell at the bottom. Because after months of watching numbers fall, their brains had been retrained. Falling now felt like the natural state. Selling felt like the rational response to a pattern that was clearly going to continue. They bought high because high felt normal. They sold low because low felt permanent. And if you think you would have done differently, if you're sitting there right now, thinking I would have seen through that, I want you to consider something very carefully. You are watching this video in a specific market environment. Your brain has been absorbing that environment every day for months. Whatever has been happening recently is quietly shaping what feels normal to you right now. And you have no direct access to that process. It's happening beneath your awareness continuously, without your permission. That is not a character flaw. It is the operating system running underneath every financial decision you will ever make. The question is not whether it's happening. The question is what you've built around it. I want to be honest with you about something. I have watched smart people, genuinely intelligent, financially literate, motivated people get completely destroyed by market crashes. Not because they didn't know better, they did. Not because they lacked good information. They had it. They got destroyed because knowing and doing are not the same thing, and in a market crash, the gap between them becomes a canyon. I've also seen something that changed how I think about this entirely. In 2020, during the fastest crash in history, a specific group of people did something remarkable. They didn't just hold, many actively bought more. And when I looked at what separated them from everyone else, it wasn't net worth. It wasn't age. It wasn't financial education. It was one thing: they had made their decisions in advance. Not I'll try to stay calm when things get bad. That's an intention. Intentions collapse under pressure, every single time. I've never met someone who said I panicked in 2008 who also said, but I had a written plan that I followed. Those two things simply don't coexist. A plan doesn't guarantee perfect behavior, but it dramatically raises the floor. What they had was a written, specific, pre-committed plan that told them exactly what to do in a scenario that felt, in the moment, completely terrifying. And because the decision had been made calmly, when the prefrontal cortex was fully online, and the fear response was quiet, it didn't have to be made again in the middle of a crisis. Their nervous systems were screaming. Their systems were running anyway. This is the single most important financial insight I can give you. The quality of your decisions during a crash is determined almost entirely by the quality of your preparation before it. Not your knowledge, not your discipline, your preparation. Let me tell you what the 10% actually do. And I want to be clear, I'm not talking about hedge fund managers or professional traders. I'm talking about ordinary people with ordinary incomes, who consistently come out of every major market crash in better financial shape than they went in. The first thing they do, they define their crash behavior before the crash. Not during, not after, before. When nothing scary is happening, when the market is calm, their nervous system is calm, and they can think clearly. They physically write down exactly what they will and won't do. When their portfolio drops 10%, 20%, 30%, not I'll try to stay invested. That's not a plan, that's a hope. A plan looks like this: if the market drops 20% from its high, I will increase my automatic contribution by $50 per month. I will not check my total portfolio value more than once per week. I will not move anything to cash unless my written financial plan, which I will not revise during a crash, tells me to. Specific, written, decided in advance, binding when it's hardest. The second thing they do, they automate everything they possibly can. Not because automation is a shortcut, because automation is architecture. A behavior that requires a deliberate choice every single time it needs to happen is a behavior that will fail under pressure. Every deliberate choice consumes cognitive resources, and in a market crash, those resources are almost entirely consumed by fear management. Automatic contributions don't care whether you're scared, they just run. The third thing they do, and this one surprises people, they study their own emotional responses before a crash happens, not during, before. In ordinary market conditions, they pay attention to how their body responds to financial news. The tightness in the chest when a headline is alarming. The urge to check accounts repeatedly when volatility picks up. The subtle pull toward doing something, anything, just to feel a sense of control. They learn to recognize those signals, not to suppress them, not to fight them. To read them as data about their nervous system, not as instructions about what to do with their money. Because the moment you can observe your fear response instead of just experiencing it, you've created the gap between stimulus and response, where every sound financial decision actually lives. Now I want to talk about something nobody is saying out loud right now. We are not in a stable market environment. I'm not making a prediction. I'm not telling you a crash is coming on a specific date. What I'm telling you is that the conditions that historically precede major market dislocations, elevated valuations, high insider selling, geopolitical uncertainty, trade policy volatility, are present right now in ways that should not be ignored. The April 2025 drop was not nothing. A 10% move in days, driven by policy announcements, is a reminder that external variables can move markets faster than any individual investor can rationally respond to. And here's what that means practically. If you don't have a plan right now, not an intention, a plan, then when the next significant draw comes, you will be making your most important financial decisions under maximum psychological pressure, with zero preparation. That is the situation 90% of people are in right now. Not because they're uninformed, because preparation feels unnecessary when nothing bad is happening. The brain is very good at telling you that you'll handle it when it comes, and very bad at actually handling it when it comes. This is the window, not to predict the future, to prepare for it. And those who use this window, who build their plan now, while their nervous system is calm and their thinking is clear, are the ones who will look back at whatever comes next and say they were ready. Not because they predicted it, because they prepared for the certainty that something, at some point, was coming. Here's what I want you to do before this video ends. Step 1, today, not this week, today, open a document and write down your crash plan. What will you do if your portfolio drops 10%, 20%, 30%? Write specific actions, not feelings, not intentions, actions. And then, this is critical, write down what you will not do. The specific behaviors you are committing in this calm moment to avoid when your nervous system is telling you to do them. This document is not for a good market, it's for the market that's coming eventually. And it needs to exist before that market arrives. Step 2 this week. Identify every financial behavior in your life that still requires a deliberate choice. Every time it needs to happen. Savings that depend on you remembering. Contributions that depend on you feeling motivated. Habits that rely on willpower. Then ask yourself one question. Can this be automated? Because a system that runs without your involvement doesn't care how scared you are. It just runs. Step 3 for the next 30 days, pay attention not to what you think about financial news, but to how you physically react to it. The speed of the reaction, the certainty it carries, the way it arrives before any analysis. You are not learning to eliminate that response, you are learning to see it. And seeing it clearly, consistently, is what creates the space to choose something different. One written plan. One automated behavior. 30 days of honest observation. The next crash is not a question of if. Every serious financial historian will tell you the same thing. Markets go up, markets go down. The cycle has repeated without exception for as long as markets have existed. What changes? What has always changed is who benefits from the recovery. In 2009, ordinary people who stayed in went from watching their portfolios cut in half to watching them grow 900% over the following decade. In 2020, those who bought during the fastest crash in history doubled their money within 18 months. The information was available to everyone. The opportunity was available to everyone. What wasn't available to everyone was a structure that made it possible to act on that information. When every instinct, every headline, every conversation was pointing in exactly the opposite direction. You are not someone who loses money in a crash because you aren't smart enough to see it coming. You are someone who, like every human being alive, carries a nervous system built for a world that looks nothing like modern financial markets. A nervous system that treats falling numbers as existential threats. That generates enormous pressure to act at precisely the moment when holding your system steady matters most. That is not a flaw. It is a starting condition. The difference, the only difference that ultimately matters, is what you build around it before the pressure arrives. The crash is not the test, your preparation is. One question before you go. If the market dropped 30% tomorrow morning, and you woke up and saw that number on your screen, what would you do in the first hour? Not what you'd want to do. Not what you know you should do. What would you actually do? Leave your honest answer in the comments. No judgment, I genuinely mean that. Because the gap between what people say they do and what they actually do in those moments is one of the most important and least discussed topics in personal finance. And your answer shapes exactly what this channel covers next. If this video gave you something that most financial content doesn't, subscribe. This channel exists to give you the understanding that changes how financial decisions feel, not just what you know about them. And the next video goes directly into the mechanism I mentioned today, the specific way your brain processes loss versus gain. and why rational financial behavior becomes structurally difficult without the right architecture in place. Once you understand it at the level we go into next time, everything else about this topic starts to click into place differently. It's already there when you're ready. Watch it next.